Welcome to Real Talk, Real Estate Discussions with Andrew Kirsch. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at scalarkirsch.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsch.
Episode 20 of Real Talk. We turn our attention to the lending industry. We have Brian Good, one of the founders and CEOs of iBorrow, on today. And we have an interesting discussion with Brian talking about the state of the lending market, specifically debt funds. A lot of private lenders and debt funds are having some issues, whether their working lines of capital are gone, or they're working through legacy assets. Their ability to lend have been hamstrung. And then with banks, well, we see what's going on in the banking industry, and oftentimes banks are still requiring, personal guarantees, or there's a ton of diligence or very low leverage. So really, the entire lending market is tight, and that's one of the reasons why we're not seeing the transactions along with the rise in interest rates. To those that don't know, iBorrow, they're a private mortgage REIT. They've done about $2 billion of real estate loans during their 10-year history. And the conversation is wide ranging with Brian, from the lending market to of course our passion of being big Dodger fans. I think you'll enjoy our conversation with Brian.
Welcome to another edition of Real Talk. I am here with my good friend and buddy, Brian Good, CEO of iBorrow. Brian, how you doing?
I'm great, Andrew. How are you?
Good. So it's really a testament, I guess, to the show, not to me, that I'm able to pull you from boot camp, from, playing 18 or 36 holes on the golf course to get you to do this podcast. So I appreciate it. And so do my audience.
Well, thank you for having me. It's an honor and a privilege to be a part of this. I love your artwork. Maverick did a really good job with the paintings behind you. But I just want to start a couple things in your world. I just want to congratulate you on a couple things. I think, your movie Maverick was nominated for an Academy Award. So I think you should be applauded for that. I'm sure you were very disappointed in the outcome. I think it was really a shame that they didn't win. So I know how much you were rooting for them. You got hosed, and hopefully he does another movie and Maverick 3 and would be right there. And I also wanted to congratulate you on the season that Northwestern State had this year. They were absolutely unbelievable. I think they were 22-11. The Demons from Northwestern State, your alma mater, just unbelievable team, and you should be very proud of that.
Wow. Okay. I don't even know where to go with that. You're criticizing my university, Northwestern University, as everyone should know.
It's Northwestern. I thought it was Northwestern State. Oh, I'm sorry. Yeah. I misread your bio. It's too bad.
And I think UCSB lost in the first round, and if I recall, I went to the first round matchup of Northwestern playing Boise State, and we won. And so we played in round 2 while UC Santa Barbara was home. Maybe they were surfing and hanging out.
No, we were busy. We're busy winning Nobel Prizes. That's what we do at UC Santa Barbara. We have 6 of them. So we were busy doing that. And Northwestern put up you should be proud of them. They played UCLA and lost. Obviously, better paid team than Northwestern. And, there's always next year.
Between Top Gun Maverick and Northwestern basketball, I had a great
a great year.
Yeah. But, this is why my audience tunes in for this kind of discussion.
That's not why we're here. We're here to talk about something else.
Yeah. So let's talk about, I want to talk about iBorrow, the history of iBorrow, what you guys are doing now, and really just the state of the market. We've only had, I think, 1 or maybe 2 lenders on this show. And so given what's going on in the banking industry, the lending market, it would be great to get your perspective. But first, Brian Good, CEO of iBorrow, tell us, what is iBorrow?
So we're a lender. We're a private lender. We used to be called a hard money lender, but no one uses that term anymore. So we're a private lender. We're actually a mortgage REIT, private mortgage REIT. We lend money on commercial real estate all around the country. I think we're in 32 states right now. We've been around 9+ years. We are first trust deeds only, short-term bridge, interest only. Market loan to value, service our own loans, and we work quickly. We call ourselves the entrepreneurial lender. That's what we do. Having come from the ownership side, in my previous life, I sort of understand what buyers are looking for and what they're not looking for. And we provide that, hopefully. And that's our business in a nutshell. One of the things we do, if I can just promote us a little bit, is we service our own loans, which I think is unique in the business right now. So we don't close a loan and then hand it off to a third party. We do all the servicing in-house, and that I think that helps a lot of borrowers, especially now when the market's changed over the last year.
So let's talk about sort of the evolution of iBorrow and also just the private lending market. And then I want to get into what we're seeing today. So,
Sure.
For many years prior to the summer of 22, for, I don't know, 7-8 years, we were in an extremely low interest rate environment. And certainly after COVID for 2 years, we were in a very low interest rate environment. So how are you guys able to compete with, other lenders that were really providing a very low interest rate product to borrowers? Where do you fall in the lending sphere?
So I'll answer your question, but I'm gonna talk about a couple things first before I get to your question.
Yeah.
So prior to, I would say, a year ago, we were still in the largest bull market in the history of real estate. Average upticks in runs in real estate 72 months historically, and we were probably, I mean, you can go back to probably 2010, 2011, when everything started stabilizing and went up in value for 12 years, give or take a year, back and forth. I've been through 3 recessions in my life, and that was by far the worst. And let's go back now 12 months from today, when rates were nothing.
Mm-hmm.
Base rates on every index was really historic lows and held that way. And then there was little upticks and things were changing. And from the index we were working on, which is now SOFR, I mean, a year ago, we were fixed rate loans at 7%, 7.5%, a couple sub 7, which were all-time lows for us, but it was the only way we could compete with banks, which were half our rate.
Sure. That's what I was alluding to.
And those loans at 6 or 7%, we were happy to get, multifamily, industrial, mostly at that rate. And we were happy to get them. It was competitive. There were a lot of banks vying for the same loans, and there was a lot of private lenders vying for the same loans also. That was a year ago. And then slowly but surely, things changed. We don't have to talk about the macro level of what was going on in the economy, but government decided it didn't want to have money out in the system, started pulling back, and rates started going up. And now we're at a SOFR rate index, which is something like high 4s. So it went from virtually nothing to the high 4s. I don't think ever in the history of our business, at least for sure in our lifetimes, and mine's a little longer than yours, have we ever had such a historic increase so quickly. And we've never had that kind of increase, but just to be going up, 450 basis points in 1 year, forget the spreads, just 450 basis points on the index has to have repercussions in the real estate industry. And I think now we're feeling that. And I think it's happening in a couple of different areas. One is a lot of real estate lenders, banks and private lenders, are just out of the market right now. banks are scared of their own shadow, and private lenders have a lot of problems, both on their legacy portfolios and also with respect to whether their working lines of capital to leverage their loans are even available anymore. So it's a monumental change in the system, and the end effect of all of this is it's got to have a downward effect on pricing.
And so you mentioned the effect it's having on private lenders.
Mm-hmm.
You're a private lender. So how has this affected iBorrow?
Well, we're a private lender, and we get our business two ways. One is borrowers have to close quickly for whatever reason. Okay. They got a great deal. They have a short escrow. They have to close quickly, and banks can't close in less than 45 or 60 days, usually longer. That's the first thing. And the second type of business we get is people that just, no matter how much time they have, they don't want to go to a bank and borrow from a bank because they don't want to sign a personal guarantee, and they don't want to deal with having to provide tax returns for their kids from 10 years ago. They don't want to deal with all of that headache. That's the business we get. I can tell you that was always kind of 50-50. Now we're getting business from borrowers who are bank worthy, have never borrowed from anybody but a bank, but have no choice but to come to a private lender. That's the difference right now. You're getting people in the door. You're seeing opportunities from borrowers that are more institutional in quality. At least we are.
So and I know every deal stands on its own, every location, asset class. Give us just a general sense of where rates are, and explain the type of product, whether it's a development deal or an income, a value add multifamily deal, the type, both the rates and also leverage.
So we don't do construction loans. So we never have. We don't like land. We don't like ground up construction, good, bad, or indifferent. I historically had done a couple when I was on the other side of the business, and I just didn't have the stomach for it. And it's cyclical in nature, and we just didn't want to do ground up construction. That was in our thesis from day one. So for 9 years, we've avoided that. We don't lend on land either. So take those out of the equations. If you look at the sort of property types, the main ones, apartments and multifamily, in our office and every other lender's office, are considered the best asset classes out there right now. And there's no difference. I would probably give industrial a little nudge above apartments, but those kind of properties, we are as aggressive as we can get on that kind of stuff, is somewhere close to 500 over SOFR. Okay. And that's cash flowing mostly, or not cash flowing. If we like the asset, we like the borrower, we like the opportunity, we like the market, around 500 over. For retail and hotel, it's really higher fives to 600 to maybe 650 over. Hotels, we did the Standard Hotel that had been shut down for a couple of years. We did that loan. We closed about a month and a half ago in West Hollywood. It's pricier loan. That's not an apartment. It's not a industrial. That's a pricier loan. And we've done retail. We're okay with retail. That's going to be in the 600s. And we've looked at office. We're not afraid of office. We're just very picky with respect to office. So those 5 categories, we're sort of in the 500 up kind of spread.
And do you give, delayed, tenant improvement, like let's say the Standard, for instance? I assume there's a big capital improvement budget that they're going to do. Or are you going to give money post acquisition closing for the renovations?
Sure. So we have, a lot of our properties are not cash flowing, so we have interest reserves. Mm-hmm. A lot of them are properties like that and industrial and multifamily that are doing value add, and we'll put in construction reserve or tenant improvement leasing commission reserve. We're happy to do that type of stuff. The key for us is obviously good borrower, viable business plan, and enough equity in the deal that they care about it. Because we're non-recourse, we want to make sure they have significant equity in the deal. And if anything goes bad or wrong, that they're just not in a position to, they don't want to just hand back the keys. They want to protect what they have invested. Those are kind of
Are
the
you
criteria we look at.
are you able to talk about the different leverage
Sure.
percentages?
Sure. So we'll go, I mean, generally we like to be in the 65 to 70% loan to value of our value. Different markets maybe push it a little higher. Different borrowers maybe a little higher, but mostly it has to do with the real estate and the market. 70% plus for more of cash flowing or somewhat cash flowing industrial or multifamily, repeat borrowers, those kind of things will push it a little more, 70+%. But the idea in our company, Andrew, is not to take over the asset. We're not a loan to own shop. We're a mortgage REIT. We have to distribute cash flow. So we want to lend the money. We want to get paid on our interest. And most importantly, we want to get paid back. People kind of lose sight of that. We want to lend the money and then they got to pay us back. That's how we work.
And what's the average term on your loans?
18 months term. So we have the ability to go 3, maybe 4 years on loans, but our average term is basically 18 months. They want it, I'm expecting it to go longer because the idea was they're going to fix it up and they're going to refinance us out with a lower, agency loan or something like that, especially on multifamily. That's not always the case right now. So I think our average term is going to go to 2+ years, which is fine. If they're paying and they're a good borrower, we're happy to do that.
Mm-hmm. So you guys obviously have been lending throughout this last cycle, and you mentioned that there are private lenders. All lenders are nervous about the source of getting paid back. So
Right.
the loans that you have on your books that you originated, post let's say 21 and the first half of 22, with an 18 to 24 month term, they're coming due this year or later this year. What is how are you feeling about getting paid back, and how are you dealing with borrowers who need more time and want more time for the lending markets to stabilize?
So that's a great question. So most of our deals right now, new deals, not a lot of acquisitions going on, a lot of refis, that kind of thing.
Mm-hmm.
Just the way the market is. But in terms of our existing loans, borrowers who were matured, we actually got a bunch of payoffs in the last 6 months. We didn't know how, but they paid us off, and that's fine. But there's really two piles of borrowers in our servicing department. There's the good borrowers and the bad borrowers. And it's really that simple. The bad borrowers are the ones who don't communicate. They're late on their payments. They always have an excuse. They're not really upfront. The good borrowers are the ones who call us. They're proactive. They're organized. They have a team that works. They look efficient. So the good borrowers are going to get the benefit of the doubt from us. Obviously, we're going to assess the property and where it's at. But if you're a good borrower and you've been communicative with us throughout the process, like we expect, then they're going to get probably an extension that kind of keeps it status quo. If it's a bad borrower, that we don't really feel like they're paying attention to us, there's going to be for an extension, if they don't have an option, they want an extension, there's going to be some ramifications to it. Pay us down, maybe float a higher interest rate, that kind of thing. So my advice to people out there, and I tell you to the new borrowers when we close transactions, is let us know what's going on. Don't hide. Don't be a stranger. Call us and talk to us. We can't help you if we don't know what's going on. And I'd rather know early rather than after the fact, because we're going to find out and we're not going to be happy about that. Be upfront. Let us know what's going on. So that's what we're, hopefully, a majority of our borrowers, vast majority, are the good borrowers, we can do it. And I think that's one of the advantages for us being servicing it in-house. We're not under some strict orders from a lender telling us what to do. We are the lender. We can make adjustments. I have 3 amazing partners. Our loan committee is scheduled to meet once a week, at a certain time designated every week, prepared, we go through it. But the reality of our business is we meet every day. We talk about our deals every day, the new deals and the existing deals. And we spend as much time on each, just going through it, making sure, and then working with our asset manager and our head of underwriting, who all know the borrower. They were all there from the inception of the loan, and we can communicate and talk to them and walk them through how we think about things. And I think people appreciate that. I think borrowers appreciate that. I think it's good for the team also. Everybody knows what's going on. Very transparent kind of group here. So when we have new deals, new transactions, we get them in early to talk to the borrowers and meet them and feel out what they're like. And it helps. There's no surprises here. But it's really that simple, Andrew. The good borrowers and the bad borrowers.
Yeah. Well, I'm sure you have your list and the naughty and the nice, and you want to make sure
we have our list and we're checking it twice. Exactly.
Yeah. And so,
by the way, we have no attorneys on the bad list, just so you know. They're all on the good list.
Well, that's the first compliment I've ever heard from you with respect to an attorney. So
yeah,
that's good to know. There's so much talk today about and here, even in our firm, we're forming a lot of funds, both equity funds, debt funds, and a lot of funds that are going to be dedicated to preferred equity.
Mm-hmm.
And so what's iBorrow's stance on providing preferred equity or mezz, either as rescue capital, so more of a refinancing type of product, or on acquisitions, as senior lenders, more conventional lenders just can't go north of 55 or 60%?
No, I think that's, we have our partners. I mean, when we're working on refis, the goal, obviously, the borrower is to come in and have a cash neutral refinance where they don't have to call additional capital and they can just refi what's existing. The reality is the values have dropped. They're behind on their plans. The income's not what they thought. So they're going to need new capital. So we identified that need 3 to 6 months ago. And we have certain partners we can work with respect to, putting a mezz or giving them somebody who can do the mezz for them. We're not in that business right now. We are looking at it. The whole rescue capital preferred equity is interesting. I think it will be interesting for the next couple of years, for sure. It's got to be the right situation. We've done it in our existence 9 years. I think we've done it once. We really like the deal, maybe twice, but we're really focused on lending. And but we are aware of the situation. There is a shortage of mezz and pref out there. I can tell you this, our average loan size is 18 million. So we're considered a smaller lender, small size loan lender. It used to be 18 million was a bigger time, but now 50 and up is kind of, our average loan is 18. So to get somebody to give a mezz of like $2 or $3 million is actually harder to get than to somebody give you a mezz of 15 to 20. There's just many more providers. Plus the cost to do that transaction, it's better at 15 to 20 for somebody to do that deal. When we did our larger loans, we have a $97 million loan. We have a $56 million loan. We've done bigger stuff. The borrower had all the money. They had the mezz lined up. They had the equity lined up if need be. But that's definitely, if the people out there looking for business right now, if you can identify people doing mezz or pref, kind of $3 to $5 million slugs, that's a really good business to be in over the next couple of years.
Yeah, absolutely. Those are amounts that, like you said, it's too small for the institutions, and I think that's why we're doing a lot of formation of funds in that arena for that type of rescue capital, maybe sub-institutional dollar sizes. Talk about when a borrower is doing business, especially for the first time with a private lender, and I make introductions all the time on the capital side, whether it's debt or equity. And the most important question today, for sure, is certainty of close. And will that capital provider be there?
Right.
So talk about iBorrow's, how you guys are capitalized, and how do you differentiate yourselves from other lenders where we've heard issues that they're having in the market today?
So that's a great question, and you have been generous to us, giving us leads over the years. So we appreciate that, Andrew. It should not go unsaid.
Well, I only asked that question so that you could give me a compliment. That was the only purpose. So now that you've
you've got your one compliment. Now we're done.
Now we can go on to the next question. I don't even need you to answer it substantively. No, just kidding.
To your listeners, all 2 or 3 of them that just know Andrew and I have gone back and forth many years discussions like this, and the bantering is always at a friendly level. The what I would say is, well, I mean, I don't know how to. I got to be a little more specific. Like,
Well, first, how are you capitalized?
okay, so we are Private Mortgage REIT. That's the general fund. That's an evergreen fund because we're a REIT and we're going to be around forever. That's how we're set up. We did enter into a partnership with Oaktree several years ago. That's public information. They've been our partner on loans, sorry, not funds, on loans for the last 3+ years, and they've been a wonderful partner. And that name has significance, obviously, in the marketplace, both on the lender side and the equity side as well. And they were recently merged or acquired by Brookfield. So now you're talking about, Blackstone type size. So that's to a borrower. When we mention our name and we mention Oaktree, that gives a level of certainty. But beyond that, our mantra here has always been do what you say you're going to do. And we've done over 150 loans, close to $2 billion in capital, and we've never retraded. Okay, so we spent a lot of time up front on our term sheets. We provide the information and we tell them what we're going to do. Unless a borrower is materially changing the terms of their deal, not telling us, lying, cheating, doing whatever, we close on how we say we're going to do the deal. And I think that goes a long way. We have that reputation. I'm proud of that. And it's very simple. Do what you say you're going to do. And for whatever reason in real estate, it's not always the case, but that's how we like to conduct ourselves.
Yeah, no, it never is the case. And what about warehouse lines? Do you guys use them?
Very little leverage. We have very little leverage. We have none on our fund. Our loans are structured, complicated loans as is. To put leverage on that may defeat the purpose. And we're already at, the yields we're getting right now are commensurate with what we really are, promising as a return for our investors. So, there's no need to complicate situations. Maybe down the road. I mean, we're always talking to banks, but I think, for our competition, they levered their loans so they would lend at 6 or 7%, and they would have 75% leverage at a floating. They have a fixed rate 7% and a floating rate leverage facility on a significant amount of debt, and those loans are now upside down or their leverage lines are frozen. So we don't have that problem.
Yeah, well, that's what I wanted to tease out so that my audience hears that from you. And then what about selling A notes?
We don't do that.
So you just keep the whole thing on your balance sheet.
Keep the whole thing in our fund, correct?
Yeah, on the fund. So when you see a downturn in the market in terms of of acquisitions, I mean, even in our business, right? For the last, I've been saying this almost on every podcast, transactional volume is down significantly. We had a slight uptick in March, and that was artificial because in the city of LA, with the transfer tax coming into place on April 1st, it almost felt like an end of the year type of cycle of deals trying to close before March 31st. Only deals in the city of LA, and now that's over. And now we're back to where we've been over the last, I would say, 6 to 8 months, 10 months maybe, in a low transactional market. Is there concern about, putting money out? Do you feel pressure putting money out? Are you not putting as much money out this year as you did last year? I mean, what are your thoughts about just the market in general and putting money out?
No, the market has slowed. I mean, I think the acquisitions, the bid ask between buyer and sellers, it's up in the air. I think, and this is normal for us, an uptick. It shows you how important the debt is on a real estate transaction. Something like 90% of all real estate transactions involve debt. The cost goes up so significantly, it has to have an effect on the overall transaction. And sellers that don't have to sell aren't selling, and buyers don't know how to price anything right now. I mean, I think there's been movement. We were at some conferences where we know cap rates have gone up on apartments and industrial already, but it's still going up. And I think until there's a definitive more definitive stoppage on increase in interest rates from the Fed, I think you're going to have this little bit of a slump. On the flip side, you've got borrowers who have funds and money that have to get out, or it goes back to their investors, and that's a problem. We don't have that demand. We don't have that stress. We don't have that in our fund. We can put out money as we see fit because we're an evergreen structure. We would like to put out money. We're not going to force the case. But the reality is we're the second line. Buyer and seller have to meet, and there has to be a transaction.
Right.
We can't force them to have a transaction.
Sure.
In some ways that's good. In some ways that's right. Like it's the same idea.
We're receivers.
We can't create this.
Yeah.
Right. You can introduce people, but they still have to agree on a price and transact. Yeah. And that's not what's happening right now. We have a lot of refinances. I would say vast majority of our deals that are in our office right now are refinances. A lender wants out. They want more time. They want more money. We're looking at a lot of those kind of things. I had a transaction come in today, which is a retail transaction. And the ask was a $60 million loan request. And, I emailed the broker. I said, we're never going to get to 60. I don't know how you're underwriting this thing. And he says, well, where are you going to be? And I'd say, I think at best we'd be at 40. And he says, perfect. We have two other lenders that are right at 40. I said, well, why'd you ask for 60 if you knew it was going to be 40? Now you have 3. I mean, does he have the money? He says, yeah, no problem. He doesn't have money, but we might as well ask. Like, okay, I give you credit for that. But that's what's going on right now. People are, I think if they need debt, they know they're going to need to have some equity and in order to make it happen. But that's the majority of the transactions we're getting right now are definitely refinances.
And so on these refinances, do you have a sense of how many other lenders are really in the ball game that you're competing against today versus, let's say, what it would have been a year ago? I mean, how robust is the competition?
So my sense is there's a lot less lenders right now in the market. I mean, yeah, I know that factually. In our business, everybody knows everyone, just like in your business. All the players, and there's people that have gone away, and there's people that are still there sitting on the sidelines. We know all of them. There's just a lot less transactions going on. But you asked earlier, how long is this going to last? What's going to happen? I think by the third quarter this year, summer is always slow, but by the third quarter, you're going to have a lot of activity. Third and fourth quarter. Fourth quarter is always our busiest, other than last year. In 8 of the 9 years, it's been our busiest by far. Yeah. And I think you're going to have that. I mean, the blip you had for April 1st, I mean, that's just luck of the draw. It's not happening anywhere else really yet.
Right.
But I think next 90, 120 days, things will settle down, and then buyers are going to get itchy, and they're going to want to close, and they're going to want to buy something. And if they've got a lot of money and they've got free reign to do it, they're going to do it. And it's kind of makes sense. I mean, I think it's the repricing. You don't want to buy it on the way down, but if you're close to the bottom and you see positive signs, it just takes a big transaction. Someone starts buying things left and right, and then everyone else kind of, follows that lead.
So in doing my hours and days and weeks of research on you, Brian, and your company, I was surprised to see and impressed on your website representative transactions that have a national scope. I believe you closed some deals recently on the East Coast. I think it was in Philadelphia. So how are you guys structured as a company? How are you able to deals on a national platform? I mean, how many professionals work at iBorrow, and are you doing deals? Well, obviously you are doing deals nationally because I saw them in Philly and elsewhere. Where are you transacting? And I guess, where are you not transacting?
Sure. I mean, like a lot of lenders, we want to be near larger MSAs. That's where there's more information available. We've been doing this a long time. We used to have regional offices. We've closed transactions, and we know the markets. We don't rely on appraisals as much. It's more, we have an appraisal, but we see every property we visit every property, we talk to every borrower, and we know the local broker community in each area that we lend in. So we've got, leasing brokers. We've got investment sales brokers in each of the big MSAs around the country. That's really the way to do it. We started locally. I mean, we started like Southern California, and then we went slowly but surely Nevada, Arizona, Texas. And then we said, okay, we're going to go east. Well, we like the Florida market. Do we like the Alabama market? No, but we like the Florida market. Then we went up north. Do we like New York? Yeah, sure. New Jersey? Sure. Boston? Sure. But do we like, Eastern Pennsylvania? I don't know. Do we like Rochester? Not as much. Larger MSAs, growth areas like Tampa, like Austin, Phoenix. We've done a lot in the Northwest, Seattle, Portland, Northern California. It's funny, we haven't done a lot of sort of Orange County, San Diego for whatever reason. There just doesn't seem to be we've tried. We've been to conferences all throughout, and there's just not a lot of private money needs, I guess, in those areas. But it's a hard thing to agree to do it, to become a nationwide lender, but we felt comfortable enough in the areas that we were lending in that that we would be okay. And I can add this: one of my partners is in New York. I have 3 partners. One lives there currently, and the other 2, all 3 of them are from or live significant time in the East Coast. So we're comfortable going across the nation that way.
Well, how many do you have actual? I think you mentioned regional offices. So how many offices are there of iBorrow?
Right now, it's just it's Seattle, it's New York, it's LA. Okay. We had some other regional offices throughout the United States, and we sort of pulled back on them during COVID. Not because we didn't want to lend there, but there's just no need to have people there yet for what we do. I mean, you know this. You can transact anywhere in the country from your office in Los Angeles, right? I mean, you're licensed in California and probably other places, but you can do a transaction in New Jersey and Florida and Texas if you need to. That's kind of how we feel. We have enough reach. We have a great asset management team, great accounting team, and our originations team is excellent. So we get that information, whatever we need. And I've been doing this, Andrew. Been in commercial real estate for 25 years. I started, behind the desk like you as an attorney for a couple of years, found out that wasn't for me. And for 25 years, I've seen the country and visited cities and tried to understand what makes a good real estate investment. Some I've made that have been good, some not so great. But you do learn the one key element of either lending or buying property, which is how much are you paying for it? Is that basis a good basis? That saves all deals. You can have the best operator in the world, but if he or she paid too much money for that property, that deal won't work. It all comes down to basis.
Yep. Brian, are you ready?
Andrew. Yes.
Are you ready for the real talk lightning round set of questions?
Did not know this was happening. Sure, go for it.
How did you not know? I mean, I think I've had like 15 or 16 episodes.
I'm gonna have. Can I have questions for you after we're done?
I would love that. No one asked me questions.
A guest lightning round of the host. Okay, go ahead.
We can switch. We can go back and forth. Okay.
We may need another podcast for that. We may need another hour. Yeah. Tell Josh. Okay. Go ahead.
All right. You talked about the artwork behind me, and this is now for the people who are watching us on YouTube and not just listening. Get out of the way.
There it is.
Whose mugshot is that behind you?
You don't know who that is? You're too young. That is, I'm trying to get in the right book. That's Sid Vicious from the Violent Femmes. Do you remember Sid Vicious?
Ah, interesting.
Sid Vicious was, I think it's Violent Femmes. Sid Vicious was one of the pioneers, and all the borrowers, when we're doing podcasts or doing Zooms, they have to see that picture. So they know eventually there might be a mugshot of them if they screw with us and don't pay it. So it's a little bit of an intimidation.
I thought Sid Vicious was a wrestler. All right, your turn. You ask me now a lightning question.
Number of attorneys in your firm that do real estate.
Oh, come on. We need.
All right. What's your true height?
Am I wearing my Lucchese boots or not?
I don't know. Flat-footed in the doctor's office. In the doctor's office.
Oh gosh.
I know the answer. It's okay.
So when I played baseball at Northwestern, yes, that's
State.
another Northwestern plug.
Yeah.
It said I was 5'8", and I am not 5'8".
You're not 5'8". Okay, as long as we're on the same page, that
I'm
less
much
than
taller.
sign.
I'm much
That's
taller.
okay.
Okay. Best golf
prepared
course.
for these.
Best golf course you've ever played.
Royal County Down, Northern Ireland.
Oh, wow. Okay. Favorite member at Brentwood Country Club to play golf with? Don't answer that.
Oh, wow. I'm not going to answer that question.
So how many strokes do I need to get from you in order to beat you?
You need, that's great. That's a great question. To beat me, I mean, you'll need 4 aside.
Okay, fine. Done. We're gonna have a wager. All right. You're giving me 8. Yep. Tell me the one market that you haven't transacted in that you'd love to transact in. I know you've already mentioned Orange County and San Diego you'd like more of, but what's a market that you just feel like you want more product in?
Tampa, St. Pete.
Reason?
We've tried and tried and tried. We've done a lot in Miami, Fort Lauderdale, other places in Florida but I like the Tampa market. It's still strong, and we haven't done anything there. If you'd asked me a year ago where I'd like to do more of was probably Austin, and we've done a bunch of loans there. But I think anywhere in Florida seems to be fine. Anywhere in Texas seems to be fine. Those 2.
Will you lend on office?
Like I said earlier, yes, has to be the right situation. And if it's a client of yours, we'd consider it. I think, value add office, this whole play of let's go in and make this incredible office building and with all the amenities in the world and spend all this money and to not have it guarantee that any tenants will show up. That doesn't seem like a great bet right now. Yeah. I think someone's going to make a ton of money on these office buildings at some point, at some basis. I don't know what or how yet, but someone's going to do it. Someone much smarter than you or I. And whether they're going to convert them, which isn't easy, or they're going to tear them down and build industrial, I don't know what, but someone's going to make money on it. It's unfortunate that I think 2 of the worst office markets in the United States are in California. Downtown San Francisco, Market Street area, and downtown LA. It's sad. It's very sad. You could not say that, a year ago, 2 years ago. I couldn't say that. Now it's just terrible. Also downtown Chicago, Midtown New York, those kind of areas are problematic, and it's a shame. And someone's going to figure that out.
Well, we closed on we saw the Union Bank transaction close at around $100 a foot just before March 31st. And I was involved in a transaction in West LA that was slightly more than 100 a foot, but it's you could definitely buy some office product for record low numbers.
We were pitched that deal in downtown LA that closed by 3 or 4 different brokers, and we just didn't see and probably at a basis we'd be okay, but we just didn't want to take that risk. We just don't see the light at the end of the tunnel. And I've a couple people, mentors who know who they are, who always told me to be scared of downtown LA, that the reckoning was coming at some point. And
so you say they've been telling you this for a long time?
Yeah. They just said they didn't understand the appeal. There wasn't enough retail. There wasn't enough things to do. There wasn't, and for what, they had a 10-year run. It was pretty good. Downtown did all right. The high rise, the condos, Staples Center. I think the mistake they made in downtown LA, and you could probably agree to this, is I think they should have put the baseball stadium downtown and put the football stadium where Dodger Stadium is. I think they should have swapped that. And I think that would have added much more vibrancy to downtown with a baseball stadium and, Metro Rail going in and out. I would go to a lot more baseball games if it was downtown versus, Chavez Ravine which is impossible. That actually, and you can put a football stadium there. It probably would have been better for the community. But they didn't do it. They don't listen to me. And now they've got
They should
problems.
have. Well, I'm going
Maybe.
to end on this final question. You brought up baseball.
Wait, is the lightning round over?
The lightning. Well, this is the final question of the lightning round.
All right, go ahead.
You mentioned baseball. You mentioned Chavez Ravine. You mentioned something that both you and I spend an ungodly amount of time obsessing over, and that's the Dodgers. And you and I, if you do recall, you actually extended an invitation, and I gladly accepted it to Game 1 of the World Series in 2017, where we won that game, and we thought, we're going to win. This is going to be the first World Series that we're going to see in person and since '88. And of course, we didn't because of a variety of cheaters and other factors. And then we got hosed because we won a World Series when no one could see it in 2020. Right. Does it really exist? So my final question for you, Brian Good, when is the next time we are going to see in person a Dodgers World Series? Is there something going on in your office that's more important than this last question?
I was just going to show you. I was just going to see if I can show you all my Dodger.
The flow. Look at this. So all the audience has to watch this on YouTube. They cannot see this.
Those are the Dodger bobbleheads. Let me see if I can get it closer.
Dodger bobbleheads.
I have Dodger stuff all over the office. So this is the year. I don't think there's a doubt in my mind that this is the year. This is the year. There's not as much pressure on them. Everyone was disappointed in the offseason. They've got the young guys going. It'll take them a little longer to find their sort of way. I think the first half of the season, which I don't mind. I mean, they keep winning 100 games and not winning the World Series. I'd like them to be that team that wins, 92, 93 games, wins 15 of their last 20, enters into the playoffs hot as can be, and just kills everybody. I think that's in them. I think they can do that this year. I love this new. I love Outman. I think he's spectacular. I think he's going to be something else. And I think all those young guys that they brought up to pitch are, guys that are going to be around a while and they're going to help them. So I'm happy. Last night was indicative of what I expect to see sort of more the second half of the season.
Yeah. Well, last year was as crushing of a letdown as can be. And now I'm just resigned to the regular season being 162 game extended preseason, and it's all about October. So I look forward to receiving that invitation to the World Series again. So thank you for that. And for beating your ass in golf with the 10 or the 8 strokes that you're giving me.
Well, I figured you would try to get free tickets out of this, and I figured you would pump up your golf game by the end of it. So I was prepared for that. So all I could say to you, I'll take the high road. Thank you for this. I appreciate it. Great to see you. Great questions. I hope your podcast does very well. To all the viewers out there, I think there's 3 or 4 today. I'm excited to hear the feedback. Your questions are great, Andrew. In all sincerity, thank you. I really appreciate it. Thank you for having us on, and look forward to speaking to you again in the near future.
No, thank you, Brian, for coming on, and the success that iBorrow has had over its 10+ year run. Everyone speaks very highly of you and the company, and keep doing the great work. And look forward to running into you in our many circles of life.
You got it. Thanks, bud.
All right, Brian. Take care.
All right.
Bye-bye.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsch. You can catch prior episodes at scholarkirsch.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.